Have you ever wondered how futures and options work in trading? Let's take a quick dive into the world of futures and options. Imagine futures as binding agreements where a buyer is obligated to purchase and a seller is obligated to sell an asset at a predetermined price and date in the future. It's like ordering a book online and agreeing to pay a set price for it to be delivered in a week's time. On the flip side, we have options. Think of options as your VIP pass. They grant you the right, but not the obligation, to buy or sell an asset at a specified price on or before a set date. It's similar to having a reservation at a restaurant. You can choose to dine there or not. Both futures and options offer intriguing possibilities. They are financial instruments that investors use to speculate on the price movement of an underlying asset or to hedge against adverse price movements. In essence, futures and options are tools used by investors to speculate on the price movement of an underlying asset or hedge against adverse price movements. Now let's delve deeper into futures. Futures are a fascinating aspect of financial trading. They are standardized contracts traded on an exchange like the Chicago Mercantile Exchange, for instance. But what exactly do these contracts entail? Well, they represent an agreement to buy or sell a specific quantity of a commodity or financial instrument at a predetermined price at a specified time in the future. When it comes to futures, there are two key players: the buyer, who takes on what we call a long position, and the seller, who takes on a short position. The buyer hopes that the price of the asset will rise, while the seller hopes for the opposite. Now let's talk about margins. In the world of futures, margin is a good faith deposit that a trader must put up to open a position. This isn't the full cost of the asset, but a fraction of it, which means you're essentially playing with leveraged money. And here's where it gets intriguing. This leverage can lead to unlimited profits if the market moves in your favor, but it can also lead to unlimited losses if the market turns against you. Futures play a vital role in risk management, allowing traders to hedge against price fluctuations. They also contribute to price discovery, helping to establish prices based on current and future estimated supply and demand. So with futures, you're playing a guessing game about the future value of an asset, with potentially high rewards but also significant risks. Now, onto options, which are a bit more complex. Imagine holding a key. This key gives you the right, but not the obligation, to unlock a door. That's precisely how options work in trading. It's a contract that grants the buyer the right, not the duty, to buy or sell an asset at a predetermined price within a certain time frame. There are two types of options: call and put. A call option gives you the right to buy an asset, while a put option gives you the right to sell. The key distinction from futures here is that you're not obligated to make a transaction. You have the option to do so. The price you pay for this right is known as the options premium. Now, this premium is made up of two components: intrinsic and extrinsic value. The intrinsic value is the difference between the current price of the asset and the strike price. The extrinsic value, on the other hand, is based on factors like time until expiration and volatility. Now here's where things get interesting. As an option buyer, you stand to make unlimited profits if the market swings in your favor, while your losses are limited to the premium paid. Conversely, as an option seller, your profit is limited to the premium received, but your losses could potentially be unlimited. Options offer more flexibility than futures, but with this flexibility comes additional complexity. Let's summarize what we've learned about futures and options. At the heart of it, futures are obligations while options are rights. This means when you buy a futures contract, you're obligated to buy or sell the underlying asset at a set price in the future. Conversely, with an option, you have the right but not the obligation to buy or sell at a predetermined price. Futures can offer unlimited profit and loss potential depending on market fluctuations. On the other hand, options have asymmetric risk-reward profiles. While the potential loss is limited to the premium paid, the potential profit can be substantial. In terms of complexity, futures are generally simpler but less flexible than options. Both, however, are crucial tools for hedging and speculation in the financial markets, allowing traders to manage risk and take advantage of market movements. Remember, while futures and options can offer substantial rewards, they also carry significant risks. Always do your research and consider your risk tolerance before trading these instruments.